Yeah, and it was actually a day where we saw a lot of FMCG companies report their numbers. Dabur was one of them. Sunil Duggal, the CEO of Dabur India, now joins in to speak about their earnings. Hi, Mr. Duggal. Thanks very much for speaking with us. This quarter around, we've seen a slight beat in terms of your margins. Although your volume growth has surprised a lot of analysts, coming in 12% higher. Is this where we hope things to move from here? I mean, is there some sort of a compromise that you might be making on the margin front to boost volume growth? Where do you see your margins moving from here?
Well, our profit growths have been good at around 18%. The EBITDA growth has been 21%. So we are not complaining about margins. I think they've been on track. But the headline number, of course, is the volume growth, which is the highest which we achieved in the last 11 quarters, in excess of 12%. So I've always maintained that we'll operate within the 8 to 12% band, and today, fortunately, we appear to be on the higher end of this band. And I believe that this 8 to 12% trajectory would continue at least for the next few quarters.
Mr. Duggal, a good set of numbers, and the market was fairly excited with it. Now, importantly, we did see also that your ad spends did taper down. So that came in around 5% up, and it stood around 190 crores. So clearly the market was quite impressed with this. What is your outlook with regard to your ad spends going ahead?
I think pretty much constant at current levels. Q4, the last year numbers were in the region of around 13%. We intend to maintain that trajectory. So there's not going to be any huge change in the ad pro ratios. They're going to be pretty much the way they were. This quarter was a little bit lower, but that's due to some seasonal factors. Nothing much to be read in that. We'll continue to maintain aggressive spends in advertising.
Also, Mr. Duggal, there's been a lot of talk about how, I know you've reported a strong volume growth, so there wouldn't be any complaints over there, but a lot of companies, there's been talk actually that perhaps, demand is not looking as good, and especially rural demand is not looking as good. Is there any concern that you're factoring in going forward from here?
Well, demand is proving to be fairly resilient, in fact remarkably resilient. If you look at the baseline products, the bottom of the pyramid brands, a little bit of easing off at the discretionary end, but the staples are proving to be resilient, at least for us. Perhaps it's a consequence of our distribution reorg and the investments which we made in both in terms of brand building and distribution infrastructure. But I think going forward, at least, we needn't worry about the demand side, particularly from rural India. We're getting into election year. There would be stimuli which will happen at the rural end. So I'm pretty optimistic about the demand front, unless, of course, there's a very bad monsoon or something which is exceptional. As we see today, things are looking pretty good.
Mr. Duggal, shifting focus, let's take us through your international business, because how exactly has Namaste as well as Hobby performed, and what's the outlook on both of them?
Well, three buckets here. You have the organic business, which has done well, as always it does well. We recorded close to 20% growth. This is largely hubbed around MENA. Pockets of weakness, particularly in Nigeria and Syria, due to reasons which are beyond our control, political reasons more than anything else. But the core GCC business and the North Africa business is performing very well. I think Hobby came out very strong set of numbers, over 40% growth, so nothing, no problematic areas in that front. The Namaste business was under pressure perhaps for the last quarter. I think we would see strong revival happening next year. So that degrew by around 10%. So overall, the consolidated numbers for overseas businesses were a little bit soft this quarter at around 11%. But again, the baseline numbers for the organic business look strong. So a mixed bag, and I think going forward we would see a better set of numbers emerging from overseas business.
And Mr. Duggal, just to come to your segmental analysis, your foods business, which it contributes about 12 to 15% of your business, that has seen a big expansion, in the EBIT margins. But in terms of your consumer care, which is actually your bread and butter segment, the EBIT improvement is not the kind of to the extent that we are seeing elsewhere. Is this where you hope for margins to sustain in your consumer care business, or do you think you could do better than this going forward? And what would be the outlook for the full year?
Actually, the foods business, despite its very strong performance at the top line, is facing margin pressures on account of the rupee depreciation and high costs of raw materials, mostly which are imported. So that's really an area of concern as far as margins are concerned. The core consumer care business is doing actually pretty good. We are riding on the back of somewhat softer raw material costs. We've also cut back a little bit on advertising, as you mentioned. So the EBIT margins of the core consumer business minus foods has actually improved. The foods business is under more pressure.
Sorry, actually there was my error on my part. It's actually down about 370 basis points. Yeah.
Mr. Dugal, what about
the foods margins?
Perfect. Well, what about your margins? Because besides the volume growth, the streets seem to be quite excited given that your margins have come in northwards of 17%. Is it sustainable? Because we have seen that it's drifted down even to the sub 15%. Is the 17% EBITDA margin sustainable?
We believe so, because I think the margins of the overseas business would now grow. That's been the soft point. If you look at the EBIT margins standalone, they are close to 21%, which are amongst the highest in the industry for the domestic business. Overseas business, particularly the Namaste acquired piece, has been instrumental in driving down EBIT margins at the consolidated levels. So I think 17 is now kind of baseline, and we should look at margin improvements over and above this. And as we are seeing a softer raw material environment going forward, we believe that will be possible.
And any price increases that are in the offing, and what would be your revenue guidance for FY14?
Well, the price increases would be few and far between. I think we are looking at, I was initially looking at around 4 to 5% price increases, but we are seeing a cooling off of commodity prices, so I'll moderate it down to around 12 or 2 to 3%. And I think revenue outlook pretty much in the mid-teens. I think that's what we should generate in the current fiscal.
All right, Mr. Dugal, thank you so much for speaking with us, and congratulations on another stable set of numbers, and all the best going forward. So that was the word coming in from Dabur India. The company has reported a stable set of numbers. So in terms of all their parameters, they have seen a growth. On that note, we'll slip into a very quick break, but we'll come back in a bit with lots more, so do stay tuned.